Here's something that should make every investor stop and pay attention. One of America's closest allies, a nation that has sat inside OPEC for 60 decades, just walked out the door. And on its way out, it told the US government it might stop selling oil in dollars altogether. This isn't some fringe theory fluting around on Reddit. Reuters reported it, the Financial Times reported it, Fortune magazine reported it. These are the most credible financial publications on the planet. And here's what's wild. While all of this is unfolding, the world's central banks are buying gold at a pace we haven't seen in living memory. Now, most people see these two events and think they're unrelated. That's called cognitive isolation in psychology, our brain's tendency to process information in separate boxes instead of connecting the dots. By the end of this video, I'm going to hand you the dots and the lines between them. I'll walk you through the exact three-step framework I use to decode what's really happening to the dollar, and more importantly, how a regular investor can position themselves for what's coming. My name is Felix Preen, former investment banker, and say hello, Winston. This is our in-house gold analyst and research hound, Winston. Good boy. Our mission here is simple. We take the information that normally lives behind closed doors on Wall Street and we put it in front of you. Because here's the thing, the big institutions already see this macro shift coming. They know exactly what it means. They are already moving. The question is, are you? So let's run the framework. Step 1, we decode the petrodollar. Not the conspiracy version, the actual mechanics, how it works, why it made America the most economically dominant nation in history. Step 2, 3 specific fractures that are cracking the machine open right now, in real time. Step 3, where are the world's most powerful institutions quietly moving their money, and what does that tell us about the asymmetric opportunities sitting right in front of us? Let's go. Step 1, the petrodollar. You've probably heard the word. Let me explain what it actually is, because having a baseline here matters enormously. Rewind to 1974. America just took a gut punch. Arab oil producers cut off supply to the US as political retaliation, and the economy bled. Gas prices exploded. People were sitting in lines that stretched around the block just to fill their tanks. It was a crisis. So the U.S. needed a solution, fast. Enter Henry Kissinger, Secretary of State, one of the sharpest negotiators in American political history. He flies to Saudi Arabia. He sits down with the royal family and he works something out. Now, and this is important, a lot of people online claim this was a formal 50-year contract. It wasn't. There was no signed treaty, no expiration date stamped on the bottom. What actually happened was the US and Saudi Arabia signed a joint commission for economic cooperation, essentially a handshake agreement to work together. But within that handshake lived 3 very powerful pillars. Pillar 1, oil gets priced in dollars, only dollars, always. Every barrel of oil sold anywhere on Earth priced in US dollars. What that means in practice is that every country on the planet that needs oil first has to go buy dollars. That creates an enormous, constant, never-ending global demand for the US dollar, built right into the plumbing of the world economy. Pillar 2, the money comes back. All those petrodollars that Saudi Arabia and OPEC nations collected from selling oil, they recycled them back into the U.S. economy by purchasing American government bonds, U.S. debt. So the U.S. could borrow cheaply because there was always a massive, reliable buyer lined up. Someone was always going to need to buy oil, which meant someone was always going to buy dollars, which meant someone was always going to buy U.S. debt. Pillar 3, military protection. In exchange for all of this, the U.S. extended military protection, weapons, and political cover to the Gulf monarchies. You scratch our back, we scratch yours. Simple. That's the machine. 50 years in operation. It's the single most important reason the dollar became and stayed the reserve currency. So, what should you care? Because when your currency is the world's reserve currency, you get what economists call an exorbitant privilege, a term coined by French finance minister Valéry Giscard d'Estaing, ironically out of frustration with American economic power. It means the U.S. can import goods cheaper than any other nation. It can run massive government deficits and still find buyers for its debt because interest rates stay artificially lower than they would be otherwise. It's basically a cheat code for the entire global economy, and that cheat code has been powered by oil. So, what happens when the machine starts breaking down? That's step 2. 3 cracks. Let's go through them. Crack number 1. The UAE just walked out of OPEC. The UAE is one of the most powerful oil and gas producers on the planet. After 60 years of membership, it officially announced it's leaving. Done. Walking away. Why? One word. Freedom. The UAE has been pouring billions into expanding its production capacity, but OPEC kept handing them quotas, telling them to cap output at roughly 3 to 3.5 million barrels per day. The UAE has built infrastructure to produce 5 million barrels. Think about that psychologically. This is what behavioral economists call reactance, the human drive to push back when freedom is restricted. You build a factory capable of producing 5 million units, and someone tells you to cap it at 3. At some point, the partnership stops making sense. And here's where it gets more interesting.
UAE didn't just leave OPEC. In 2024, it joined the BRICS nations, a coalition actively building economic alternatives to dollar dominance, and their own central bank publicly stated they might be forced to shift oil sales to the Chinese renminbi. Let that land for a second. A U.S. ally openly talking about moving away from the dollar. Why? Because China is the UAE's single largest oil customer. And with the geopolitical instability building across the Gulf, locking in a long-term revenue stream with China makes strategic sense. Saudi Arabia, America's original petrodollar partner, is also deep in negotiations with China for long-term oil contracts, 10, 20-year deals, potentially priced in renminbi. Russia, you already know, they got cut off from the Western financial system entirely and pivoted hard toward China and India. And India just completed its first rupee-denominated payment for UAE oil. Most people don't realize that we are watching in real time a dismantling of the dollar monopoly in global oil trade. This is not fringe speculation. It's confirmed. It's documented. It's happening. Crack number 2, the exit from U.S. government debt. Remember Pillar 2? Oil money gets recycled back into American bonds. That was the engine that kept U.S. borrowing costs low. That engine is sputtering. China's holdings of U.S. debt have dropped by roughly 50%. Now, I want to be precise here because I don't want to overstate it. Some allies like Japan and the UK have actually been buying more U.S. debt, so this is not a universal global dump. That framing would be misleading. But here's what actually matters to me. The countries that are pulling back from the dollar, where is that money going? Gold. Crack number 3, and this is where your portfolio becomes relevant. After Russia's foreign currency reserves were frozen by the West, a decision that sent shockwaves through every finance ministry on Earth, central banks everywhere experienced what psychologists would call a schema shift, a fundamental restructuring of how they understand risk. The realization was stark. If your reserves sit in dollars or euros in Western banks, those reserves can be frozen with a single phone call overnight. No warning. That changed everything. Since that moment, we've seen record-shattering gold purchases by central banks. We're talking roughly 1,000 metric tons per year. And it's not just China and Russia. Poland, Uzbekistan, Kazakhstan, countries across the world are doing this quietly, systematically, and consistently. This is institutional behavior signaling something. When the smartest, most risk-aware institutions on the planet all start doing the same thing at the same time, that is a signal worth understanding. Now, let's connect the geopolitics to your portfolio, because that's what actually matters. Gold didn't just go up a little. From the breakout point, it surged approximately 60%. It's pulled back slightly from its highs, but it has held remarkably strong, even while countries like Turkey have been selling gold to manage their own currency pressures, and Gulf nations have reportedly been liquidating some positions because dollar inflows have slowed due to Strait of Hormuz disruptions. Despite all of that selling pressure, gold is holding. That's called price resilience. And when an asset holds strong despite known selling, it tells you the underlying demand is serious. If you understand what that chart pattern means, you're in the top fraction of 1% of retail investors. And if you want me to break that down, we'll do it live. More on that in a second. Let me give you the 3 Ds, the structural reasons why, in my opinion, gold wins in this environment. And before I go further, I am not a registered financial advisor. This is my analysis, my lens. You need to make your own decisions. But if you look at this through an institutional lens, here's the thesis. D number 1, de-dollarization. Everything we just covered, central banks rotating out of dollar reserves, oil sellers pricing in alternative currencies, the dollar's monopoly eroding at the edges. This is a structural, multi-year shift away from dollar dependency. That's demand for a dollar alternative. Gold is the only truly neutral one. D number 2, debasement. The U.S. government has been running enormous deficits for years. Every dollar of new debt dilutes the purchasing power of every dollar already in existence. Economists call this monetary debasement, and it's essentially a slow, invisible tax on anyone holding cash. Gold cannot be printed. It cannot be diluted. Its supply grows by roughly 1 to 2% per year through mining. That's it. The Fed can't create more of it overnight. D number 3, diversification. We're living in an era of what I'd call geopolitical fragmentation. Europe is rearming. The Middle East is volatile. Trade routes and alliances are shifting. And governments around the world are waking up to the concept of concentration risk. The danger of storing the majority of your national wealth in a single currency controlled by another country. Gold has no nationality. It has no counterparty. It cannot be sanctioned. It has functioned as a store of value for 5,000 years across every civilization that's ever risen or fallen. This isn't about being a gold bug or a doomsday prepper, though I think both communities understand something most people don't. This is about portfolio construction in an era of genuine multi-directional uncertainty. So what do you actually do with this? Option 1, physical gold. You own it. You hold it. Nobody can freeze it or sanction it. The trade-off is storage, insurance, and security. Option 2, gold ETFs. Much more accessible. You can buy and sell like a stock. You don't need a safe or a shotgun. For most investors, this is the practical entry point. Option 3, gold miners. Here's the thing about miners. They're a leveraged play on gold. When gold rises, mining company profits can rise much faster because their cost structure is relatively fixed, but they also carry more risk and volatility. One name worth watching, NEM. It's been lagging the gold rally, which is interesting. It's not quite right yet, in my view, but it's moving in a direction worth tracking. We'll break it down live. Let me be clear about something before I close. The dollar is not going to zero. It is not collapsing next Tuesday. The United States has the largest stock market in the world, deep institutional infrastructure, and enormous global investment demand. None of that disappears overnight. But here's what's changing: the dollar's unchallenged monopoly. That's the part that's fading, and the entire exorbitant privilege America has enjoyed for 50 years was built on that monopoly. Understanding how the system was built and how it's shifting puts you ahead of the vast majority of investors, not because you are smarter, but because you're informed. That's information asymmetry working in your favor, not against you. If you want to go deeper, join me at felix.training. Link is in the description. We're going to run a live session this weekend. We'll go through specific analytical frameworks, case studies, and identify exactly where the opportunity is right now. But more importantly, I'll teach you the process so that in 3 months, 6 months, 3 years, 10 years, you can find the next opportunity yourself. Teach it to your kids. The process doesn't expire. It's free. It's live. Bring a pen, paper, and a willingness to think. I'll see you there.